Hello, ladies and gentlemen, and welcome back to your favorite regulatory news channel, the CRR III channel of PwC. My name is Martin.Neisen. I'm a partner with PwC here in Germany, and I'm leading the Global Basel IV initiative. Today, we are going to give you an overview about the European Banking Package 2021. And as the name suggests, there are several EU documents that are affected by this banking package. And to give you this overview, I'm not doing this alone. I have a colleague today with me, and I would like to welcome Stefan Röth. Stefan.
Hi, Martin.
Wie geht's dir?
Very good. It's a grey and rainy November day, but I'm excited to discuss with you the news from the CRR3 today.
Yeah, great. As I said before, it's a European banking package and several EU laws are affected. Stefan, could you please give us a short overview which EU laws are affected by this banking package and give us a short overview what is the content of these EU laws?
Yes, sure, happy to do so. Of course, the most eagerly awaited changes are to the Capital Requirements Regulation, the CRR3, so the European implementation of the first pillar of the Basel framework. But there are other changes as well, for example, to the CRD, the Capital Requirements Directive, and also the BRRD, which governs the recovery and resolution of banks.
Thank you very much, Stefan. One thing is on the tip of my tongue, and that is the question regarding Basel IV versus the finalization of Basel III. You have to explain that to me, because on the one hand side, the EU Commission speaks about the finalization of Basel III, and that is implemented within European law. On the other hand, the banking industry is always speaking about Basel IV. What is it now? Basel III, Basel IV? I'm a little bit confused.
Yes, that is a topic that has provided a headache to many of our listeners. Starting at the very beginning, the Basel Committee introduced the term Basel III back in 2010 with their immediate reaction to the great financial crisis. And since then, it has become a term that is much used referring to that 2010 ideas of the Basel Committee that have been implemented in the EU in 2014. But ever since then, the Basel Committee has not been idle, but they have published new papers and finalized what they call the Basel III framework in 2017. However, as Basel III was already in 2010, a lot of participants of the industry started to use the term Basel IV to refer to everything that has happened since 2010, and these are the ideas that are now part of the CRR3.
Yeah, and I think also because of the sheer amount of changes within this finalization of Basel III, that's why they call it also Basel IV. Yeah, Stefan, one of the biggest surprises of the draft of the banking package 2021 was the date of implementation. Can you please explain to me and to our people on the screen why everybody was surprised?
Yes, sure. The idea of the Basel Committee, coined in 2017, was that these changes should enter into force in 2022, which was already 15 years after the breakout of the great financial crisis. Then came COVID, and it was postponed to 2023. And looking back to CRR2, we know that sometimes the EU needs a little bit more time, so everybody was putting his money on 2024. Now, it's not even 2024, but 2025, and there is transitional provisions that go all the way to 2030 and beyond. So more than 20 years after the end of the financial crisis, this really shows the huge, important framework that is being developed here and that has taken so much time to implement.
Thank you very much, Stefan, for this first insights. I think the biggest amount of changes will be within the CRR, the Capital Requirements Regulation. Stefan, could you please give us a brief overview of the changes within the CRR?
Yes, basically the CRR3 complements what has been started with the CRR2 and now introduces changes to some of the most important topics, in particular credit risk, which is, at least for most European banks, at the heart of their business model. So there will be changes to both the credit risk standardized approach and internal model-based approach. and also changes to the measurement of operational risks and the CVA risk capital charge. And finally, there is the topic of the capital floor, which is important for all the internal model banks and who will certainly change the way that banks are calculating their risk-weighted assets.
Thank you, Stefan. Correct me if I'm wrong, but I think alone in the CRR there are 213 pages of changes. So it's really a huge amount. And of course, banks will be heavily affected by that. But let's dig a little bit deeper. Can you give us a first glance at what are the changes within credit risk?
Yes, sure. Let's start with the standardized approach to credit risk. And here the idea of the Basel Committee has been to make this approach more risk sensitive because it is at the heart of the floor, the capital floor rules, and therefore needs to provide a better view on risk than the current standardized approach. This has led to a couple of changes, some of them clearly designed to increase risk-weighted assets, for example, when we talk about equities. And there is also, and this is particularly important for banks here in Germany, a lot of changes to the treatment of mortgage loans and real estate collateral. Then we have the IRB approach. Here the problem was not to make it more risk sensitive, but to make the results more comparable across banks so that the risk-weighted assets remain an important signal of actual risk. And in order to achieve that goal, the leeway that banks have to model has been somewhat restricted, for example, by looking at the scope of application of the IRB approach and also by introducing parameter floors for the PDs and LGDs.
The second big type of risk that is going to be changed is market risk. And between credit risk and market risk, there's always a tiny little type of risk that is going to be changed as well, and that is the CVA risk capital charge. Before we come to market risk, maybe, Stefan, a few words about CVA.
Yes, sure. CVA was introduced by the original Basel III framework back in 2010 to take into account quite recent developments that became visible at the head of the financial crisis. And because these rules were introduced so fast, well, it's no surprise that there needs to be some adjustments to be made. And these have been published by the Basel Committee and will now enter into the EU implementation with CRR III. However, still leaving in place some exemptions that have been agreed when the EU implemented the Basel III framework.
Yeah, and that was always a big criticism of the European implementation, these exemptions, because on global level, these exemptions do not exist. Yeah, now going to market risk. We all heard about the big topic of fundamental review of the trading book. The fundamental review of the trading book was already part of CRR II. What is now within the CRR III? Can you give us here an overview?
Sure. As you rightly pointed out, already CRR II contained a lot of wording on the fundamental review of the trading book, and in particular the new approaches, standardized approach, internal model approach to calculate capital requirements for market risk. However, purely as a memo item. So it needed to be calculated, it needed to be reported, but it would not impact the capital ratios of the banks. And here CRR III comes into play with two major changes. First of all, these new approaches are now part of the capital ratios and not only something that is a pure memo item that the supervisor is interested in, but will have an impact on the banks, their capital ratios, and also their business. And the second large or big change is the definition of banking book and trading book, which was not part of CRR II, which surprised a lot of us back at the time, but which has now been incorporated into the CRR III and will also have a huge impact on how specific instruments are being assigned to trading desks on the one hand side or the banking book on the other hand side.
Yeah, I think especially this definition of trading is underestimated by a lot of banks because it really defines what is actually trading and what not. And it could be definitely the case that banks that are thinking they have no trading book right now, that they will have a trading book in the future, and vice versa, that they have trading activities and that they will become banking book activities in the future. So that is definitely an important point that is very often underestimated. Yeah, last but not least, when we speak about the types of risk, we have operational risk. Yeah, sometimes people say that it's the smallest part of the risk types, but I think here also the changes are quite fundamental. Can you give us a quick overview there?
Yes, as proposed by the Basel Committee, all the existing approaches to measure operational risk are being replaced by a new standardized approach. So there will be in the future no longer an advanced measurement approach or internal model approach for the measurement of operational risk. And there is also some surprises when it comes to the implementation of this new standardized approach within the EU, because the EU choose to make use of a right of choice that the Basel Committee has foreseen, but that was certainly not meant to be applied in that way as the EU now has elected to do so.
Yeah, as far as I remember from the consultation phase from the Basel Committee, it was a discretion that was meant for, I would say, not so developed countries, and that it's now a discretion that was chosen by the EU Commission is a little bit strange, I must say. But of course, it's a relief for the bank because it's less complicated to implement. Yeah, and then there's one topic that everybody was discussing in advance, and that is the output floor. Stefan, what is the output floor? Can you help me?
Sure. The output floor means that internal model banks need to recalculate their risk-weighted assets based on standardized approaches, and then the overall capital requirements are floored at a specific percentage, 72.5%, of the value that is based on the standardized approaches. In other words, even if you use internal models, you can never reduce your capital requirements below this point of 72.5% of the standardized approach risk-weighted assets. And it's therefore obviously meant to restrict the amount of modeling and restrict the amount of optimization that banks can do based on internal models.
Yeah, the output floor was one of the topics that was discussed in advance a lot, especially how the EU will implement it and compared to other implementations on global level, especially how it's implemented in the US and so on. And here I think it's very important to mention that the floor is already applicable for the large US banks, and they even have a 100% floor. So for them, the requirements are much more strict, and it will be interesting how the US will implement it. So if they will reduce the floor from 100% down to 72.5%, because that would be definitely an advantage for them. So that was the first overview of what is inside of the CRR3. Stefan, there are a lot of changes. What do you think? What are the most important changes, and why are these changes important?
Yeah, I think the answer to that is quite clear, because for most banks in the EU, the changes to credit risk in combination with the capital floor will be the most important ones. That's not to say that operational risk or CVA are not important, but quite obviously for most banks the changes to the credit risk standardized approach, IRB approach, and in case of an internal model bank, the capital floor will be the most fundamental changes to the way they calculate risk-weighted assets since Basel II was introduced back in 2006.
Thank you very much for that overview. Looking to the overall package of CRR3 and comparing it to the original documents of the Basel Committee, Stefan, what do you think? Is the CRR3 an exact implementation of Basel IV into European law, or are there any deviations, EU specificities that are considered? Can you give us your opinion?
Yeah. As usual, the EU implemented quite everything that the Basel Committee has proposed, but at some specific points they made changes that may seem very small when you look at them for the first time, that indeed they have quite a big impact. So, for example, we already talked about operational risk, where the EU elected to use the so-called business indicator component only and not look at historical op risk losses for the calculation of the capital requirements. The same is true for CVA. There was a so-called DS factor introduced that does nothing else but reduce the capital charge for the so-called basic CVA by 35% as compared to the Basel rules. And finally, when it comes to the floor, the EU has softened the impact off the floor by introducing transitional provisions that run for several years and that reduce the amount of capital requirements for unrated corporates or for real estate financings, and thereby so reducing the standardized approach RWA and thereby vastly reducing the impact that the floor will have in the first few years.
Yeah. So it can be said that the impact regarding the capital requirements of the CRR3 and compared to Basel IV was reduced. So the increase in RWA is not so big as expected, but it's still big. And what is very, very important, we as PwC, we were making a lot of impact analysis in the last months and even years. Basel IV and therefore CRR3 is very variable with regard to the impact. So there will be banks that face a huge increase in their capital requirements, especially when they're hit by the output floor. On the other hand, we see also banks that have a decrease in their capital requirements. And of course, all banks, no matter if it's a decrease or an increase, they will react to it and they try to make the best of it from a strategic point of view, and it's important to look at that. And last but not least, what is also important, what was not changed is the impact of the implementation costs. Because there, I must say, the EU was making it even a little bit more complicated so that the implementation costs for the CRR3 will even increase. Okay, that's it regarding the CRR. The CRR is an European regulation, which means, of course, that it's directly applicable to all European banks. On the other hand, we have the CRD, the Capital Requirements Directive, and a directive means always that it must be implemented into national law. So let's have a quick look to the CRD. Stefan, what are the biggest changes within the CRD?
There is basically three changes that need to be mentioned. The first one is not restricted to the CRD, but also relevant for the CRR, and that is the introduction of ESG into the regulatory framework, not as a way to impact the calculation of risk-weighted assets, so there is no green or brown factors as has been discussed at length, but there are certainly a number of impacts that the treatment of ESG risk will have on the way that banks do business. And when we look at the CRD in particular, it means the introduction into the SREP process, it means the interconnection between ESG risks and capital buffers, so there is quite a lot of connections that are now being made obvious in the revised CRD. Apart from that, we have quite a lot of changes on the treatment of third country branches. Also a very interesting topic for those that are hit by these changes. And finally, we have the topic of supervisory powers and the harmonization or the further harmonization in Europe of the supervisory powers that regulators have when it comes, for example, to the change of control of banks, mergers and acquisitions, how they are involved in these processes and what tools they have at their disposal to ensure that the merged banks apply to the rules at hand.
Thank you very much, Stefan. One controversial question. Does the changes have anything to do with the Brexit, what we see in the CRD?
Not obvious, of course, but there are at least two topics where I think it's safe to say that Brexit will have an impact. The first one I just mentioned is the treatment of third country branches. So we now do have another third country that is just a few miles away across the channel with a lot of subsidiaries and branches in the EU, and for them these new rules will be very, very relevant. And the other topic that I think does have to do something with the Brexit is also the harmonization of the so-called fit and proper process. So the requirements on the management and supervisory board of banks in the EU, which are further harmonized.
Yeah, thank you very much, Stefan. Last but not least, we also have the BRRD, which is also a directive, so it must be implemented into national law. It's the smallest part of the banking package, of course, but small does not mean that it's not important. So please, Stefan, quick overview about the content of the changes within the CRD.
Yeah, with regards to the BRRD, we are really talking about minor changes, so not the introduction of completely new ideas, but rather some recalibrations made on the experience of the last few years when it comes, for example, to deductions of MREL eligible instruments, or when it comes to the interplay between the so-called single and multiple point of entry strategies for a bank resolution. These have been introduced into the BRRD, but as I said, not the game changers that we see when it comes to the CRR, for example.
Okay, thank you very much, Stefan. Yeah, that was already a very good overview about what is part of the banking package 2021. And Stefan, you are one of the biggest experts we have within Europe on Basel IV, the CRR, the CRD and the BRRD, but you're also German. Could happen. So it would be very interesting for me. What do you think? What are the most important changes within the banking package for the German banks?
Well, obviously, the changes from the CRR3 are the most relevant ones. And as I said in the beginning, the changes to the credit risk approaches and the capital floor will have the biggest impact. To pick just 2 points that I would like to highlight, we have on the one hand side a much more complex treatment of real estate collateral. That will be a huge challenge for banks in Germany who are very much engaged in this particular type of financing. And on the other hand side, we also have changes to the treatment of unrated credit institutions, which can no longer be risk weighted based on their country of residence. And that will also have a huge impact, in particular for the large number of small banks in Germany that do not have an external rating yet.
Okay, Stefan, thank you very much. Ladies and gentlemen, thank you very much for your attention. That was our quick overview of the European Banking Package 2021 with the first details on the CRR3, the BRRD and the CRD VI. If you are interested in more details for each of these topics that we presented today to you, please stay tuned on your favorite regulatory news channel, the CRR3 channel of PwC. There will be several other shows where we present you more details about credit risk, market risk, operational risk, the third country branches, and so on and so forth. So please stay tuned. Going to see you there. Bye-bye.